We have our national editor for ET Now, Aisha Faridi, who will be taking the stage, and joining her is going to be none other than the senior partner and CEO at Rare Enterprises and the co-founder and mentor of the Trust Group. He has risen to the top of his game, needs absolutely no introduction. Welcome on stage, ladies and gentlemen, Mr. Utpal Sheth. And our next speaker is the perfect insider for the know-how of the market, and I'm talking about the director at Enam Holdings, Manish Chokhani. Ladies and gentlemen, a round of applause for this power-packed panel. Over to you, Aisha.
Please. So today, like Mr. Ashish Chauhan just said, that we have two veteran speakers here with me. That's Mr. Utpal Sheth and Mr. Manish Chokhani. You must have seen them on ET Now very, very often. But thank you, both of you, for being part of our 15-year celebrations. Couldn't have asked for more.
Many
That's
congrats.
our privilege. Thank you.
Thank you so much. Yeah, Manish, you were saying.
No, many congratulations.
Thank
Been
you
a
so much.
fabulous journey.
But like Mr. Chauhan was calling you both veterans, and I'm not going to ask you how old you are, because I don't want the question to be asked to me back. But you guys have seen the equity market journey being pretty much born in equity market families. It's in your DNA, right? I mean, if someone were to take their blood test, it wouldn't be A positive or B positive or O. It would be Sensex, Nifty, and now Smiths. How does it feel tracking the journey for India equity markets from back then in the bull ring at the BSE to now the fourth largest in terms of market cap, Utpal?
You know, there's this interesting Hindi song. It says, "यूं तो हमने लाख हंसी देखे हैं, पर तुमसा नहीं देखा."
Yeah.
I think one can say that about this bull market.
Yeah.
And you know, while people talk about returns in a bull market, I think what is most amazing about this bull market is the consistency and the resilience of this bull market. I think we've had 49 months without a 5% dip in the market in any month. This is the first time it has happened. Both Manish and I have been in the markets now for more than 30 years, and we haven't seen that. Manish.
But at the same time, Manish, you know, I always remember your quote when I remember the first week of June. What happened on 3rd June, 4th, and to where we are now. When 3rd June, the markets reacted to the exit polls, cheered up 3.5% on the index. 4th June, sorry for the bad recap, but it's almost like a motion picture in my head. And then 4th June, you had that 7% tank, and now we're at an all-time high. So, you know your quote from Lenin, there are decades when nothing happens, and there are weeks when decades happen. How does it feel?
So, as Utpal also said rightly, that this first time the power of retail, which we are seeing in India, is something we've been waiting for literally 30 years. And just to put in context, as Ashish was also saying earlier, if we are a $4 trillion economy and we save about 25%, our saving rate is $1 trillion a year. And even with the amount the retail is holding today, it's whatever, 7-8% of the 5 trillion, it's a $400 billion number, which is less than 1 year of their saving. So it's a 10% allocation at best to equities, which has still come. And for a country which has an average age of 27, 28, you would expect the allocation over time of saving will become 70%. That's the journey countries like US and UK and all, when they were growing, went through. We'll see this happening. Having said that, I just want to put a note of caution there that you pay a very high price for a cheery consensus. And right now, from the RBI governor to the government, to the investors, to the retail, everyone sees only clear blue skies. And as he said, 49 months without a correction feels great. But to be an investor, you don't get fixed income returns every month in the stock market, which people seem to be getting used to. So at some level, you wish people know what is the difference between risk and reward, because right now we are only seeing rewards. So not wanting to, puncture the happiness index
The
right
party.
now, but let's keep that also back of our mind.
Okay, I'll give you enough opportunity to play bad cop, but talking about, the good that we're at, the kind of, optimism that you heard in the governor's voice to all the speakers we've had before you. We're at 21 crore SIP inflows on a monthly basis. We're already the 4th largest market cap. equity markets. We already know the number of demat accounts, which are ranging from anywhere between 8 crore to 15 odd crores right now. Yet the depth is still not there. We're growing, but we have so much potential to go to what US or China and Japan have been, the economies which are doing, or rather the equity markets which have done better than us. Utpal, what are we staring at in the next 15 years? The demographics that Manish talked about, what could it blow up to?
Before we talk about the next 15 years, let's deconstruct this bull market. The index going up is typically EPS multiplied by PE. So there has been a dramatic increase in the PE. One can take that as a sign of froth, or one can try to look underneath and see what is the structural change that we are looking at. Structurally, I think 4 or 5 things have happened, apart from all the other things that you mentioned. One, the interest rate differential between India and the US is now much lesser than what it used to be. The second is that the forward rupee depreciation rate is lower. Third, volatility of exchange rates and interest rates is structurally lower. Fifth, I would say that the banking system is the strongest that we've ever seen. And so on. I can go on. So what this reflects is a structural reduction in risk. And it is that structural reduction in risk and vulnerability of the system that is driving the re-rating of the Ps. With that as the context, when we are talking about the next 15 years, I think the next 15 years will have to be driven by earnings growth rather than continued P multiple expansions. As Manish was explaining to you today, a very large, probably the highest number of companies are now quoting at more than 50 times trailing 12-month earnings that we've ever seen in our lifetime. Having said that, the conditions for future earnings growth is dramatically different. One of my pet theories is terminal value investing. And instead of applying that to a company, if we are to apply that to India and say what is the terminal value of India, then I think one comes up with very interesting possibilities. Okay, our manufacturing potential, or the per capita income changing, or as they talked about, financial deepening in the economy. I think we are getting to a point where the confluence of all of these factors is giving us the outcomes which we have not earlier imagined. So I would say that India is an idea whose time has come. And in the previous conversation, one of your colleagues asked the question, is India an asset class by itself? And I would say that we are well on our way to being an asset class by ourselves. Amongst all emerging markets, there is no other market which can absorb that quantum of capital that India can and still deliver the kind of ROEs. If you compare Indian ROEs with other emerging markets, you will find that Indian ROEs are significantly superior. So we've got all the key drivers. We've got growth, we've got ROEs, and we've got capacity.
But Manish, for now, are all the positives in the price?
Well, a lot of it is, but like I've been talking with you earlier as well, it's been a rotational bull market. So it's not like everything has participated at the same time. So as one sector goes up, something else doesn't perform, and then it rotates into that. And we are playing a classical, what I call emerging market growth paradigm, which I saw in the 70s when the world got excited when it was the rise of Japan and Taiwan. It did happen. Then in the 2000 to 2010 decade, it was really the rise of BRICS led by China, where again it happened. And I've seen from the 70s when the gold standard and Bretton Woods came into being, we've alternated every decade between growth and then hard assets. So if you go back to 70s, you saw the rise of gold and silver and the famous Hunt brothers, the peaking of oil. Then it went into Japan and Taiwan in the 80s. In the 90s, it went back into NASDAQ. And the 2000 to 2010, it came back to BRICS. And actually, India, China did nothing for 2010 to 20. Our returns weren't great, despite all the things we can say about it. And it went back to NASDAQ. And this decade, again, in theory, belongs to commodities and emerging markets like India. And we will rise inevitably. And I do think conditions are ripe for India to be the center of that vertical rise in this decade. Having said that, all I want to caution is you don't anticipate a bubble and then buy on that basis. You can get lucky and participate, like it happened with technology, that you participated in the technology boom through the Infosys and Wipros, and they went vertical. But when prices went to a level which couldn't sustain, while the companies continued performing post-2001, the stock prices went nowhere for 10 years. And that's the risk we run into if we create bubbles. Which is why when the RBI governor talks of caution and monitoring and not allowing exuberance,
The Ferrari.
it's similar to when earlier Hero Honda came to India or Bajaj Auto scooters used to have a waiting list. People would put booking amounts down. Same thing happened when real estate was going through a cycle in 2000. People were putting that 90-10 schemes to book the flats. Currently, we are doing that with stocks. With the derivative market is 400 times of the underlying cash market. So we can't be creating, a sustainable bull market on the basis of that. We definitely have all the fundamentals in place, as Utpal rightly points out. And the income curve of India is certainly suggestive of that. And again, just to give you that same math again, why we should remain bullish, while I'm giving you caution on prices, the reasons to remain bullish are fantastic. We still have only 7% car ownership in India, of which 90% is Maruti and Hyundai. That category, which elsewhere in the world you don't really classify them as cars, they are called one-box cars. If you double it from there, at some 15 or 16% people own washing machines, which is again not a great number. Air conditioning in a hot country is even less than that. So you can see what kind of growth lies ahead of them. Then you double and you go to up the income curve. Only a third of Indian homes have refrigerators at 33%. And then you go even higher, 50% have two-wheelers. So aspirationally, everyone wants this. But the reality of life is 0.3% of India, less than 500 million people, pay 80% of India's income tax. That's the Taj Mahal hotel, consumer, which, will, and every scooter owner also eventually wants to go to Taj. So the potential for earning growth for, like he says, terminal value for the country is enormous. And the acceleration you see in demand, because the income curve is so steep, is very dramatic. So this wealth effect, as it kind of gathers velocity, one would expect to see a lot of acceleration in earnings, which so far we are not seeing. If people argue that the banking sector can only grow at 15%, it tells you what can be the top line growth for companies. The country's central bank is still guiding you for 7.5% growth. With 4% inflation, that's 11.5%, 12% nominal. The better companies will do 15. Earnings will be 15 to 20. The prices are 50 multiple. That's the dilemma today, that you need that sort of earning acceleration to come. And where we see that, for example, retail or EMS are comfortably growing at 50% for the next few years. No one's going to get off that train, because as long as the momentum's there, there's no reason to get down. But some others which are very deeply cyclical, let's just take defense as an example. Maybe defense is fantastic, but 45 multiple, 50 multiple, and the delivery record of a lot of these companies hasn't been great. What happens if there's disappointment over there? So is just keep that balance in mind is all I'd like to submit.
But Manish, that what happens no one can predict. That's the out of the box moment. You see a company, you see growth, and who's to say 10 years from now, there's valuation and the historical multiples.
No, you said the best thing. 10 years from now, if you have holding capacity, you shouldn't be selling anything good that you own. That is the secret of the wealth of Titan or Infosys or whatever.
But I'm even talking about buying something. Should valuation for a country which is growing like India and for the equity markets which have the potential that they do, and I would still say that we're at a nascent bull market right now. There is, decades to go and humongous more growth to come in. Why should I look at multiples?
So again, Utpal come in as well. For 35 years we are invested. We've made fantastic returns, but it hasn't been you buy the same stock and sit on it for 30 years. There are one or two, even the best examples in the 90s. Sunil will remember Hindustan Lever used to be in 1998 a 3,000 rupee stock, adjusted 300, and it didn't perform for 10 years after that. It's Hindustan Lever. Every Indian uses it, whether there's a up cycle, down cycle, economic cycle, whatever. Same thing happens to an Infosys or a Wipro in 2001. The stock doesn't perform for 10 years. In the 2008 upcycle, the Reliances and the Vedantas were leading the bull market. They didn't perform for 10 years. They eventually quadrupled. In 21 onwards, Reliance quadrupled, but for 2009 to 2020, it gave you no return. The same thing's happening now, that in the previous cycle, we were all buying retail banks, so the HDFC Bank and Kotak Bank. And HDFC Bank was equal to the market cap of the entire PSU pack. Today, the shoe's on the other foot. You want to own the so-called corporate banks, which is SBI, ICICI, Axis, which were the hated banks of the last cycle, and the PSU banks. They've gone from a profit of 30,000 crores to close to 2 lakh crores. That's the rate of change in PSU banks. And they're still, I would submit, at book value or 6 or 7 multiples, whereas the defense stocks are on 45. So we're paying a lot for anticipation and not for something which is delivered. You get these dichotomies sometimes, and those become the opportunities. So while I agree that this country has a great future, I'm completely with him on board. We guys are always 100% invested, but it's not always the same horses which go through every cycle.
But in your scheme of things, Utpal, because you really look at the long-term horizon, how important is valuation and the price that you pay for a stock as a criteria?
Valuation is surely important. That valuation has to be seen in the context of that terminal value. But just to support some of the points that Manish was making, our market cap to GDP now is a little over 1.4x. The last time that we were a little over 1.4x was in 2007. Okay? But at the same time, USA today is 1.9x. Okay? Does not mean that we have earned the right to be 1.9x. For sure not. Okay? So there is definitely overexcitement in some parts of the market. But overall, if you see the earnings trajectory, I have never seen Indian corporate sector to be more confident of their earnings trajectory than now. Okay? And clearly the reduction of risk, or rather reduction of systematic risk or vulnerability of financial markets has gone down. I think the supply response is what is most required, in the sense that even now, the total quantum of paper being issued in the financial markets in the context of our market cap is very, very low. We've gone through a large corporate deleveraging cycle. We will see larger issues coming up, like we are seeing Hyundai coming up.
Ola, yeah.
Ola coming up. So these are larger size issuances. As we see more and more larger sized issuances, we will see more sanity returning to the valuations.
But Manish, valuations is one thing, and like you said, horses remain the same, the courses are going to change. In the next 5 years, do you buy more of the same that you're buying right now, which is, XIT and right now FMCG, the pure play companies?
No, like I said, cyclically, you would expect emerging market commodities to be the trade of this decade. And in that, again, to supplement Utpal's point, normally you would expect great supply response. What I find, though, yet in India is we are still playing yesterday's game. So whether it's to do with our currency or our policies or the way the corporate sector wants to spend, if we are the third largest economy in a few years, this currency cannot remain the way it is. It is a store of value. If we are the leaders of the global south, why on earth are people holding currencies which they know are getting debased and printed every day? It's like someone's taking out a rights issue and you're still pegging your price to the X rights price of that currency. So that needs to change. So that's, at a very macro level. At a governmental level also, if, like the Prime Minister said, we want to go faster. If you want to create 10 million jobs a year, you need 10% dollar rate growth, which is a 14-15% nominal. We're currently happy with 11% type nominal. So that 3% extra delta can give you staggering amount of growth. So some of these things need to change. The corporate sector is so burnt with the last decade of deleveraging that we still haven't said, let's go to 0.5 debt to equity, 1:1 debt to equity. If we make a $200 billion sort of profit after tax for the corporate sector listed, the demand for new investments is not coming from corporates to SBI and the others as yet. We are still investing 25-30% of GDP, but the bulk of it is going to real estate. So if my central bank, my government and my corporate sector is not ready to, grow faster, that earning growth which we are all expecting is currently not looking like it's going to be as great as one is expecting. Also, if you're going to go from number 5 to number 3, there's no country which has done it only on the back of being a processor for somebody else. So you will see a lot of, Taj hotels will proliferate all over the world. The JLR car will proliferate all over the world. Indian brands have to carry and go all over the world. The way you see the Samsungs when Korea went up or when Japan went up, you saw Sony and Toyota. Or you're seeing with the Chinese today. So if that sort of productized thinking, and those are the sorts of companies we look for now, that these will be the new big leaders which become platform plays. It's NSE. I don't think anyone could have imagined 10 years ago that NSE would be making this level of profit. The same thing, SBI, chairman was here, he will cross $10 billion of PAT. He'll be at 83,000 crores. He's shy to say it. There are staggering numbers which are coming up. They will cross because our mind used to be blown with the numbers the IT companies were making. But you see what the financials will be doing 2 years from now and what that delta does to, lending power. If the Tata Group is willing to make the bets which they are making today on semiconductors, they are the ones who want to lead EMS. It won't be the current space. So there are things which are coming out and we keep our eyes open. And also, historically in these conditions, the supply response from India, whether it was Reliance or Adani or SBI, the issuances have to be 10 billion plus. Today, the foreigners and the Ps are realizing this and they are selling down. The Indian corporate sector has not yet bitten the bullet and said we can raise a lot more money and grow a lot faster. So I think, like RBI governor said, let's see the pitch is very, very conducive. But if you don't hit the ball for a 6 and you defend thinking last time I got out, that's the Virat Kohli situation today in the T20, right? He's gone to open, he's supposed to whack it, but he's looking at Rohit Sharma that you hit and I'll defend. And so if I think we cross this bridge, the conditions are absolutely ripe for 5 se 10. But how fast we make it, is it in 5 years or 7 years? I think that's really the debate.
Whatever it may be, Utpal, 5 years, 7 years, 10, 15, right? All of us are going to be here and all of us are going to be a participant and a spectator of the Indian equity markets. You always believe, don't bet on the monkeys, bet on the gorillas. I want you to explain that theory to all of our viewers here.
So, I think India has undergone a structural change where there is a shift from the unorganized sector to the organized sector. Within the organized sector, there is a shift from the weaker players to the stronger players. As an investor, one needs to recognize that and participate in that process, which is why the focus on gorillas. What is the fundamental difference between gorillas and other monkeys? 1, gorillas are rare. 2, gorillas are dominant. 3, gorillas have a lifespan which is more than double that of monkeys. Okay, so they have longevity. So companies which demonstrate these characteristics, to our mind, are gorillas. If you do a historical analysis, whether in India or any other good developed capital market, anywhere in the world, you will find that bulk of the incremental value creation in any mega trend or any new sector over many decades is captured by the top 3 or 4 players only. Therefore, it is essential to participate in that. For example, in the 90s, if you had bet on the IT sector, but if you had ended up with a Pentaforce software or a Satyam software or a Visualsoft, right, then you were in trouble. So getting the megatrend right is important, but getting the leadership right is equally important, if not more. And if you get both these right, only then will you participate in the wealth creation process. What is it that determines this leadership characteristic? To my mind, it is intangibles. It is no longer tangibles. The kind of culture that a company has, the kind of institutionalization that a company has, and so on. Therefore, I focus on these three markers for me as which are megatrends, leadership characteristics, and intangibles to identify potential future gorillas.
So where is it that you see the future gorillas right now? Let's discuss the mega trends.
Okay. I'll classify megatrends into three buckets. One is the well-known megatrends. So what are the well-known or more mature megatrends? Megatrends like consumption and premiumization, or financialization of savings, would be long-term megatrends, well known to all of us, or even the digital growth. A few megatrends which are not so well known, like India's female labor force participation rate is actually quite low. If India is to be what we all expect it to be, then our female labor force participation rate has to go from around 30s to around 60s, where China is today. And whether we take 10 years, 15 years, or 20 years, but that needs to happen for India to sustain the GDP growth rate. The percentage of population which is above 60 is 11% today. But this is going to double by 2050 or so. That change of demographics will throw up another set of opportunities. These are the kind of megatrends which are less well known or well appreciated. And there is a third set of megatrends, which is in the technology space. Whether we talk about artificial intelligence, electric vehicles, renewables, recycling, and so on. All of those are technology shifts. So there are many megatrends which are in process. You don't have to participate in all of them. You just have to build your conviction in a few of them and find the leaders in those spaces.
But again, Manish, it's kind of obvious who the leaders are in the spaces that he just talked about. But the prices that they quote at right now, even if you want them in your portfolio, would you be willing to pay that kind of price?
So I was the first guy to talk about caution on prices and what you pay for. But again, just to complete his point of, the 5 big trends which we've been talking for years, which are finally playing out, that as this country's income level inflects up, it was very obvious that consumer discretionary will be great. And that starts with what we're doing with housing. So real estate cycles come back after 15 years. What we're doing to automobiles, then what's happening with home improvement, what's happening with discretionary spend on experiences, tourism. You've seen what's happened to hotel and airline stocks, for example, over here. So this trend is not changing. And like I explained, the income curve is very steep in India. So the operating leverage companies in discretionary space, if you do really have that 5 and 10 year outlook, for some of them, if you draw the number out, the numbers are very staggering. So it's not necessary, and again, Utpal will supplement, that just because it's a high P doesn't mean it won't deliver returns. Because if it keeps delivering the earnings, and therefore it will then sustain that multiple, you can create enormous wealth. But you be damn sure of that earnings and your ability to hold for long term. That's what's defined, whether it was IT in the 90s, it was holding for 10 years which gave it. And that final blast which happened between 98 and 2001 was the real delta. If in 98 I thought Infosys is expensive and I sold it, I missed all the fun in the last 3 years. So that for consumer discretionary is still an opportunity, but multiples are in some cases north of 100. Most of them are 50 to 70. So you must get that level of earning acceleration. It won't happen in FMCG, but it'll happen over there. The second are platform plays, which are all these tech companies. Again, multiples are berserk. But that's really where technology disruption is happening at the margin. Now, whether it's a home delivery guy, or whether it's a B2C brand, or whether it's a e-commerce type site, and so on. So
but is 200 a good price
just
for Zomato?
I'll quickly wind up. 3 is your financials.
Ignoring my question.
Sorry.
I said, is 200 a good price for Zomato?
I can't comment on individuals, but I'm saying this whole thematic of platform plays where India will productize, and you don't then spend incremental money. So when a consumer company creates brands, and you go from a Tata Tea to Tetley and Starbucks, which is what they're doing successfully, or like they're doing in their hotels, and they're differentiating across the categories, that gives you operating leverage. Or your cumin, people would have not thought of it in the past. So what they're doing is fantastic, and I won't steal their thunder by, So if that's kind of, another big theme, financials, this center point of the country will pass through financials. And it's not just the banks, the wealth management companies, the mutual funds, the stock markets, enough range of things to play there. The fourth one was where you're privatizing. Historically, each time the government vacated a sector, the profit pool came to private sector, and they tended to be natural oligopolies. So it's happened already in telecoms. They vacated telecoms, they vacated airlines, and so on, like they did in the past with banking, or they did with media, and so on and so forth. So all that is also still coming. And fifth, the whole policy push is manufacturing. We want to go from whatever 16% of GDP to 25%. So you can expect all the policies to come directionally in favor of whether you're doing semiconductors, your PLI will come for semiconductors, electronics, pharmaceuticals, chemicals. Question is, as he rightly said, who has the guts to say, I will put a world-scale plant, I will beat BASF? Because the opportunity today is ITC's market cap is already bigger than BAT, which was the parent. The entire market cap of Suzuki is represented by the value of its holding in Maruti. The rest of it is free. Even more shocking number I'll give you. If you take out the Bharti Telecom value from Singtel, Singtel is worth 0. That's what the market thinks about it. So the world wants to give us money. We are saying we are not ready to take that money and explode our businesses upwards and grow. And I do submit again, if I was still 10 years ago, I used to be an investment banker, I would be going out and raising tens of billions of dollars for all these large corporates, plus borrowing money left, right, and center from bond markets and the banks, which will allow you to accelerate the earnings which the market's giving you. We missed that opportunity even in IT. Infosys used to be what multiple, Wipro used to be what multiple. They didn't acquire companies at that time to grow. And we went at the end of the cycle in 2007, and we went and bought Chorus, and we went and bought, what is the one which Hindalco bought? GLR. At the top of the cycle. The point is, can we do it as corporate India early rather than later? ICICI Bank went and raised huge money, remember, 2007. And then stock didn't go anywhere for that period. So the opportunity is we will get returns if the companies deliver. So the ball is not with the stock markets to take you 5 to 10. The ball is always with the value creators are the companies of India. And they have to see that earning acceleration coming, which is really what both of us are saying.
So Mr. D'Souza and Mr. Chatwal will be very happy if you think that's where the mega trends lie. Is it IHCL and Tata Consumer?
Yes, it is surely a mature mega trend, and they've clearly demonstrated that they are leaders in that space.
Okay, so we'll throw it
I
to
will
the...
say, Aisha,
yeah.
that the only group which is showing a mindset of productization is the Tata Group among the mega.
A huge round of applause.
So, really.
So Manish, I know our time's been up, but can't let you go before you sing 2 lines for us to describe...
That was Vijay Kedia. He's the singer.
He will join in, definitely. I'll make sure he does. To describe India right now, to the way the markets have been, and of course for ET now.
Well, right now, I remember there was a movie called Do Aur Do Panch ki jo soche jo chahe wo karke dikha dein. Hum wo hain jo 2 aur 2 5 bana dein.
Okay, good one at that. Vijay Kedia, would you want to join with a line? No. Okay, later then. Thank you so much, all of you. Thank you, both of you.
Thank you.
All right, getting leadership right along with getting the mega trends right. That's how you can look to create wealth. And we loved hearing as well some of those interesting lines and maybe some musical prowess later on in the evening.
Absolutely. Looking forward to that, Mr. Chokhani, Mr. Sheth and Aisha. Thank you very much for joining us.